a comprehensive guide to whole life participating insurance for business owners and wealthy families in Canada. Most Canadians think of life insurance as just protection for their family. But what if I told you it can also be a powerful tool for building wealth, reducing taxes, funding your retirement, and creating a financial legacy that can last generations? Today, we're diving deep into how whole life participating insurance can transform the way that you think about your money. Hi, I'm Laurent Munier, partner and advisor here at Safe Pacific Financial in Vancouver. And if you're new here, welcome. And if you've been here before, welcome back. At Safe Pacific, we specialize in helping Canadian business owners and families grow, protect, and transfer their wealth using advanced but easy to understand financial strategies. If you want to talk to us about your own plan, visit safepacific.com and send us a message through there on the contact form. But now let's jump in. So what is whole life participating insurance in Canada? Whole life insurance is often called PAR insurance, and it's one of the most powerful financial tools available to Canadians who want to grow, protect, and transfer their wealth tax efficiently. Unlike basic life insurance that only offers a death benefit, whole life participating policies also build guaranteed cash values over time, creating a living asset that you can use now while you're still alive. So here's how it works. You pay the premiums into the policy. A portion of those premiums funds the guaranteed death benefit, and the rest goes to the insurance company's participating account, or PAR fund, where it grows and earns tax-advantaged dividends. So those dividends can then be reinvested or withdrawn or used to pay premiums, or they can increase your coverage. Some key benefits of Canadian whole life participating insurance are that it has a guaranteed death benefit. So your beneficiaries will receive a tax-free payout no matter when you pass away. It's got tax-advantaged cash value growth. Your cash value grows tax-deferred inside the policy and can be accessed through policy loans or collateral loans without immediate taxation. It's got dividend flexibility, so the dividends can be used to purchase more insurance, which is called paid-up additions. It can reduce your premiums, or it can be taken out as cash. It's also got asset protection, which is really important for intergenerational wealth transfer. So whole life policies can help to shield your wealth from taxes and create a legacy for future generations. And in many provinces, life insurance proceeds are creditor protected if you set them up correctly, which adds another layer of financial security. So why whole life insurance is a true asset class? In traditional thinking, Canadians tend to view life insurance simply as an expense. But a properly structured participating whole life insurance policy is a tax-advantaged, low-risk, income-generating asset, much like real estate or dividend-paying stocks. When you include a participating whole life policy in your financial plan, you add stability, liquidity, and tax efficiency to your wealth-building strategy. So, comparing whole life participating insurance to stocks and bonds. This happens all the time. So the whole life insurance stabilizes your investment portfolio by providing guaranteed returns in an otherwise unpredictable market. It offers liquidity, so you can access the cash value when needed without having to sell investments at a loss or paying heavy taxes. It also enhances your estate plan by offering a seamless, tax-free way to transfer wealth to the next generation. Unlike a taxable investment portfolio that can shrink under probate or through capital gains taxes when you die. So why do Canadian business owners and wealthy families use whole life insurance? Well, across Canada, high net worth families and incorporated business owners often use whole life participating insurance because it minimizes exposure to volatile markets. It can also shelter assets inside your corporation in a tax-efficient way. It also provides capital that can be leveraged for investments or for retirement or for business expansion. And it can create a rock-solid, tax-free foundation for intergenerational wealth transfer. So institutions like Manulife or Sun Life or Equitable Life and Canada Life manage some of the largest participating accounts in the country. And they invest heavily in real estate, private fixed income, and infrastructure to ensure stable returns. Now let's talk about corporate-owned life insurance for Canadian business owners. So this can unlock massive tax and wealth transfer advantages for you. So if you are an incorporated business owner in Canada, corporate-owned life insurance, or you'll sometimes see it online as COLI, C-O-L-I, is one of the most powerful wealth-building and tax-saving tools available. So instead of leaving retained earnings exposed to high corporate tax rates or traditional investment risks, you can use whole life participating insurance inside your corporation to protect, grow, and transfer wealth more efficiently and tax effectively. So here's exactly how whole life participating insurance works and why it's becoming a cornerstone strategy for Canadian entrepreneurs and incorporated professionals. So number one, there's a Capital Dividend Account, or CDA, which helps you to extract retained earnings tax-free from the corporation. And here's how it works. So your corporation purchases a whole life or universal life insurance policy. When the insured person, which is usually a key shareholder or the owner or you, passes away, the death benefit is paid directly to the corporation. A significant portion, which would be the death benefit minus the policy's adjusted cost base, gets credited to the CDA, the Capital Dividend Account. Funds in the CDA can then be distributed tax-free to Canadian resident shareholders, such as your spouse or children or your heirs. And then this allows you to extract retained earnings tax-free instead of paying, 40% plus capital gains and dividend taxes. It can also help to fund shareholder buyouts or pay estate taxes, or simply to just pass on the wealth efficiently. So here's a pro tip. Structuring your corporate-owned life insurance correctly ensures maximum CDA credit. And we at Save Pacific specialize in designing policies that optimize this benefit. Another one is the immediate financing arrangement, or IFA. So you can access liquidity while you're also funding the insurance. Now, do you want to fund a large whole life policy, but you also want to keep your corporate cash liquid for investments or for business expansion? So the immediate financing arrangement allows you to do both. So here's how an IFA works in Canada. Number one, your corporation purchases a high cash value whole life insurance policy. Then you use the cash surrender value, or the CSV, as collateral for a bank loan. And then instead of tying up all your capital, you borrow against the policy while continuing to grow the cash value. And you only pay the interest on the loan, much of which can be tax deductible if you're using it for investments or for business purposes. So when you pass away, the death benefit pays off the loan, and the remaining funds pass tax-free through the CDA to your heirs or to Canadian resident shareholders, which allows you to keep your money working in your business or in your portfolio. It allows you to benefit from life insurance growth and tax advantages, and it allows you to maintain liquidity while securing your estate plan. So note, not all banks offer IFAs, and not all insurance companies design policies optimized for an IFA strategy. So at Save Pacific, we work with Canada's top lenders and insurers to structure immediate financing arrangements that fit your goals. So it's really important to work with somebody who knows what they're doing if you're setting up an immediate financing arrangement or IFA. You definitely don't want to work with somebody who doesn't do this all the time. This is what we do all the time. We're really good at it. If you are looking at doing an IFA, please come to us. Please don't go to someone who's never done it before. So the Insured Retirement Plan. This is tax-free retirement cash flow. Another corporate life insurance strategy that's growing in popularity among wealthy Canadians is the Insured Retirement Plan, or IRP. An IRP is perfect for business owners who want to build a tax-advantaged retirement fund without withdrawing taxable dividends, who want to access capital later in life without triggering tax events, or who want to leave a substantial tax-free death benefit to their heirs. Now, here's how the Insured Retirement Plan works in Canada. First, you fund a whole life participating policy inside your corporation during your working years. The cash value grows tax-free while you run your business. And then when you reach retirement, you use the cash surrender value as a collateral to obtain a line of credit from a bank. And then you withdraw tax-free loan proceeds to supplement your retirement income. So on death, the insurance payout repays the loan, and then any remaining death benefit flows tax-free to the beneficiaries through the CDA. This will allow you to generate a tax-free retirement income without liquidating investments. It'll also let you minimize tax exposure during retirement, and it'll ensure a tax-free estate transfer after death. So why Canadian business owners shouldn't ignore corporate-owned life insurance? With smart planning, corporate-owned whole life insurance can shelter retained earnings inside your company while minimizing taxes. It can create tax-free capital for shareholders through the Capital Dividend Account. It can maintain liquidity while still funding a large insurance policy with an immediate financing arrangement. It can build reliable retirement income through the Insured retirement plan. And ultimately, it can protect your family and your business partners by, say, funding a buy-sell agreement or having an estate equalization strategy. So whether you are funding your business or growing your corporate investments or you're planning your retirement, whole life corporate insurance gives you flexibility, security, and tax-optimized wealth transfer options that traditional investments simply can't match. Now here's how you do the wealth transfer and estate planning using whole life insurance in Canada. So when it comes to protecting your hard-earned wealth and passing it efficiently to the next generation, whole life insurance is one of the most powerful financial tools available for Canadian business owners and families. A properly structured whole life insurance policy not only creates a guaranteed tax-free death benefit, but it also ensures that your estate transfer is smooth, protected, and tax optimized. Unlike traditional investment assets, which are often exposed to capital gains tax or probate fees or legal disputes. So now here's how you can use whole life insurance for estate planning and intergenerational wealth transfer in Canada. Intergenerational wealth transfer means that you can leave a legacy that grows tax-free. One of the smartest ways to use whole life insurance is through intergenerational wealth planning. And here's how it works. Parents or grandparents purchase a whole life participating insurance policy on their children or grandchildren. This cash value grows tax-deferred inside the policy for decades, benefiting from compounding and dividend growth over time. On transfer, the policy can pass outside the taxable estate without triggering capital gains tax. And then the death benefit is paid tax-free directly to the beneficiaries. So this will grow family wealth in a tax-advantaged way. It'll protect heirs from large tax bills on estate assets, and it'll create multi-generational financial security. Now here's a pro tip. Structuring the ownership and beneficiary designations properly is critical for maximum tax efficiency and asset protection. This is something that we do and we specialize in at Say Pacific. Another thing is the family banking system, or the Rockefeller method in Canada. Now imagine creating a private family bank that your children, grandchildren, and future generations could borrow from, without ever having to rely on traditional lenders. So this is the concept behind the family banking strategy, which you can find online as the Rockefeller method, and how family banking with life insurance works. A family trust or key family members fund whole life policies over time. Instead of withdrawing or cashing out policies, family members borrow against the cash value. And they can do this for university tuition, home purchases, business investments, emergencies, whatever they want. This ensures that the cash value continues compounding uninterrupted, protecting the family's capital and teaching future generations financial discipline and stewardship. And then this will create a self-sustaining pool of family capital. This will teach your financial literacy and responsible borrowing to the next generation. And this will preserve wealth across multiple generations. So here at Safe Pacific, we help Canadian families set up that family banking system using top quality whole life policies so that your wealth can support generations that you might not even have met yet. So whole life insurance and trusts. You want to protect wealth with the maximum amount of control. Another powerful estate planning tool is owning life insurance inside a trust. And by setting up a trust as the owner and the beneficiary of a whole life policy, you can control how and when the death benefit is distributed to the heirs. You can protect your family wealth from divorces, from lawsuits and creditors, from poor financial decision-making by heirs, from kids who have problems, maybe gambling problems, alcohol, drug problems, or they just spend a lot and don't know how to not do that. We've actually helped families with this. So this structure is especially valuable, if you've got minor children who aren't able to manage a large inheritance, or you've got a blended family. So, there's a remarriage happening and there's kids from this former wedding and there's kids from this former marriage, and you've got a blended family and you need to somehow equalize an estate. And you want to protect assets from business risks or personal liabilities. So by implementing this strategy, you'll ensure that your wishes are legally enforceable. You'll safeguard your family's financial future. You'll minimize family disputes and estate challenges. And really important, setting up a trust correctly requires coordination between your legal team, your tax team, and your insurance team, which is why we would work closely with, the top estate lawyers or accountants to deliver a fully integrated wealth transfer plan or estate plan. So here is how we do life insurance versus a traditional fixed income investment in Canada. So when most Canadians think about conservative, stable investments, they immediately think of bonds or GICs, which is a guaranteed investment certificate. So while these can serve a purpose, whole life participating insurance offers a powerful and tax-efficient alternative that outperforms these traditional financial investments over the long term, while also providing liquidity, tax advantages, and estate planning benefits. Let's break it down. You get stable, reliable growth without the headaches of interest rate cycles. You get tax-free compounding inside the policy. And you get flexible liquidity through policy loans at your discretion. And you get guaranteed legacy transfers to the beneficiaries how you set it up. So now, why does participating insurance policy have an edge over bonds or GICs? So leading Canadian insurance companies like Manulife, Sun Life, they invest a large portion of the participating account into private fixed income assets, into bonds, into commercial mortgages, into real estate. And so these investments offer, high yields, and they've got a bond team that can probably get better yields on better bonds that you might not have access to. By combining these types of investments, you've got lower default rates due to the insurance company's stringent underwriting. You've got more stable returns than publicly traded markets. So when you own a participating whole life policy, you're indirectly benefiting from these professional, large-scale investment portfolios without having to manage the complexity yourself. So here at Safe Pacific, we help our clients structure their whole life policies for maximum growth, for leveraging the strength and the stability of these major insurance companies, and to grow your wealth safely over time. Canadian real estate investors, why should you love whole life insurance? If you're a Canadian real estate investor, whole life insurance could become one of your most powerful financial tools. And here's how. Well, you could acquire new properties without selling assets, right? You can use policy loans or collateral loans that are backed by the cash value to fund your down payments, to fund legal and closing costs, to fund fees, to fund renovations, all sorts of different types of investments that you have when you're working with real estate. You can keep your money working. So while you borrow against the policy, your cash value continues to grow tax-free inside the policy, which maximizes your capital efficiency. You also get flexible lending on your terms. So unlike traditional banks, policy loans are private, flexible, and under your control. There's no credit check, there's no income verification, and there's no stress. Now, if you're doing collateral loans with a bank, you do have to go through a credit check and you do have to qualify for the lending with the bank, but you have this super secure asset in the policy, in the cash value, that the banks love to lend against. You've also got tax advantages. If you're using policy loans, those proceeds are generally not taxable as long as you're borrowing below the adjusted cost base. If you're borrowing through collateral lending through a bank, those policy loans aren't taxable. So you have this huge tax advantage, and the strategy can be paired with corporate planning. So if you own properties through a holding company, you can also maintain your estate planning goals. So even while you're leveraging your cash value, the tax-free death benefit remains in place, and this protects your family and future beneficiaries. And pro tip, many Canadian real estate investors use whole life cash values to continually reinvest, creating a snowball effect for generational wealth. Now let's compare the best whole life insurance companies in Canada. So choosing the right insurance company is crucial for maximizing the benefits of your whole life strategy. So here's a quick guide. Now, Manulife, they're really good for the immediate financing arrangement, or IFA, and other business lending strategies. Sun Life has a strong allocation to real estate and private fixed income, so this is really good for higher stability. Equitable Life, they've got really rapid early cash value accumulation, which is ideal for policy loans and policy lending. Canada Life, they have the largest participating account in Canada with consistency and stable dividend performance. So at Safe Pacific, we have direct relationships with all of Canada's top insurance companies, and we can help you to pick the right carrier based on your goals, whether that's maximum growth, liquidity, or legacy creation. Also, something to consider is the actual underwriting. So which company is going to actually take your business? So underwriting is super important on deciding which Canadian life insurance to go for when you're using whole life insurance. And here's some final thoughts of why whole life insurance is essential for Canadian wealth builders. Whole life insurance isn't just about protecting your family, even though that is the main reason that you should be getting it. It's a dynamic, tax-efficient asset class that supports every stage in your wealth journey. It gives you tax-free growth and liquidity for investments or retirement income, powerful corporate and estate planning advantages. It's got low volatility, stable returns that complement your real estate and equity holdings, and it's got guaranteed probate-free wealth transfer for your heirs or your favorite charities through the death benefit. So whether you're a business owner, a professional, a real estate investor, or the family patriarch or matriarch, integrating whole life insurance into your financial plan can dramatically improve your long-term results. Now, if you're ready to build your strategy, you want to talk to us. At Safe Pacific, we really specialize in this. We specialize in designing customized, tax-efficient wealth strategies using whole life participating insurance. And if you're serious about optimizing your investments, about protecting your family, minimizing taxes, and creating a legacy that lasts for generations, reach out to us here at safepacific.com. On there, there's plenty of ways to get in touch with us. Any messages that come through us will go to the team. Somebody will reply to you within 24 hours to set up a meeting. That meeting usually takes 45 minutes to an hour, and we'll really get to understand your situation and your goals and your concerns and see if we can even help you. What you want to do next? Go to our website, safepacific.com, fill out the form there. There's probably a link underneath this video that's going to take you right there. And before you go, if you got some value from today's video, please do all those things that help the algorithm. Number one, you want to click the like button. That's really important. Number two, if you're not subscribed yet, why not? Hit subscribe. That's super easy to do. If you have any questions, you can email them to us directly through the website or leave a comment below. We check them all the time and somebody on the team will reply. That's it for me today. I'll see you next time.